You're listening to the AIA Uncut podcast, the place where we bridge the gap between traditional finance and the future of technology. I'm your host, Brian, and today I'm joined by Bethany. We're keeping it simple and getting straight to the point. Let's get started. So, looking at the calendar, it is February 4th, 2026, and I have to be honest, the mood out there it's just weird. It's confusing.
It's really a split-screen reality right now.
Yeah, it's like, depending on which app I open on my phone, I feel like I'm living in two completely different timelines.
A tale of two markets. That's the perfect way to put it.
Seriously. Yeah. I look at my tech stocks, read the headlines about AI, and it feels like everyone is popping champagne, a total boom. But then I check my crypto portfolio, or honestly, just look at the price of groceries, and it feels like a crisis. It's just a sea of red.
It is chaotic, but there is a very specific logic driving that chaos. JP Morgan is actually calling it multidimensional polarization.
That sounds like a physics problem.
It essentially is one, but for money. And so the mission for this deep dive is to figure out why those forces are pulling in opposite directions. We need to look at why tech and gold are hitting these historic highs, while, crypto and oil are plummeting.
And there's a regulatory war tying it all together.
Yes, a war happening inside the White House right now. It connects everything.
Okay, multidimensional polarization. Let's start with the big picture then before we get into the weeds. The economy. Are we booming or are we busting? Because the signals are so conflicting.
It depends entirely on where you sit. We are seeing a classic K-shaped economy.
Right.
But the angle of that K is sharper than it has been in decades. The arm going up, that's all AI. The expansion of investment there is just, it's relentless.
It's a winner-takes-all situation.
It is. If you work in tech or utilities that power data centers or, say, healthcare systems adopting these tools, your world looks fantastic.
Right, because companies are just spending billions. We keep hearing about CapEx, capital expenditure.
CapEx is at record highs. But here's the catch, and this is the downward slope of that K. That spending is decoupled from the labor market.
Decoupled how? I mean, usually when companies spend money, they hire people.
Not this time. They are spending on infrastructure chips, servers, concrete, power grids. They are building the brain of the future company.
But not hiring the people.
Exactly. They are very, very cautious about hiring actual humans. Job gains have stalled out. So we have this really weird situation where GDP growth looks resilient on paper.
Because of all this hardware spending.
But the average worker isn't feeling any of that warmth because labor demand is just soft.
That explains the vibe shift. The stock market is partying because of the hardware, but people are stressed because of job security. But wait, if the labor market is soft, if people aren't getting hired, shouldn't that bring inflation down? Usually when people have less leverage, prices drop. Shouldn't the Fed be cutting rates to help us out?
You would think so. That's the textbook answer. But we are just not living in a textbook right now. We're dealing with sticky inflation.
Ugh. Sticky is the worst word in finance.
It really is. The Federal Reserve met just last week, January 28th. Everyone was hoping for a cut.
Yeah.
But they held rates steady. Still in that 3.0 to 3.75% range.
So no relief.
No relief. Because inflation is just hovering near 3% in the U.S., it refuses to come down.
Why, though?
There's a structural reason that people aren't talking about enough. Immigration policies have shifted significantly recently, and that has tightened the labor supply.
Okay, so let me see if I have this right. We have fewer available workers due to policy, which keeps wages kind of sticky.
Right.
Combined with massive corporate spending on tech, which keeps prices for things high.
Exactly. As the analysts at JP Morgan put it, we can't have our cake and eat it too. We can't have this robust, tech-driven growth and super tight labor markets without keeping inflation elevated.
So the Fed is basically sitting on his hands saying, sorry, we can't give you cheap money yet because the engine is running too hot.
Precisely.
Yeah.
And that lack of easy money, that lack of a rate cut is, well, it's sucking the oxygen out of the room for another sector.
I know where you're going with this. My painful portfolio, crypto.
The elephant in the room.
The crashing elephant. We are looking at the charts today, February 4th, and it is ugly. Bitcoin dropped below $80,000. That was a huge psychological line.
A huge line in the sand.
Now we're trading around, what, 75 to 78,000?
It's a brutal correction. We've seen over $1.2 trillion in market value just wiped out.
1.2 trillion. In 6 weeks.
In 6 weeks. To put that in perspective for you, that's like the entire GDP of a G7 country just vanishing from the ledger. The fear and greed index is sitting at 14.
14.
14. That is categorized as extreme fear.
That feels right. I feel the fear. But help me understand the why. A few months ago, everyone was screaming, 150K by Christmas. Is this just bad vibes? Or is something mechanically broken?
It's mechanical. It's what analysts call a liquidity vacuum.
Okay, pretend I'm 5 years old. What is a liquidity vacuum?
Okay, so imagine a crowded nightclub. For the last year, the club was full of cash because everyone thought the central banks were going to lower rates.
Passing out free drinks, basically.
Exactly.
Yeah.
That was the synchronized easing of 2025. Everyone was buying. But now the central banks have turned off the free drinks. They're keeping rates high.
So the party stops.
Not only does it stop, but the people who borrowed money to be there, the leverage, they get kicked out. And when they try to sell their assets to leave, there's nobody standing at the door with cash to buy them.
So there's no buy sign?
That's the vacuum. So when someone sells, the price just drops off a cliff because there's no buffer.
And then the algorithms kick in and make it worse.
Exactly. And passive funds, robots, basically, they see the drop and automatically sell to protect themselves. It becomes a chain reaction. Selling begets more selling.
I saw headlines about whales panic selling. Are the big guys actually shaking, or is that just Twitter noise?
Oh, they're shaking. Look at MicroStrategy. Michael Saylor.
The biggest Bitcoin bull on the planet.
Right. They just bought another $2.13 billion in Bitcoin recently. But with this drop, their holdings briefly traded below the price they paid for them.
Ouch. Being underwater on a $2 billion bet has to be nauseating.
It rattles confidence. When the retail investor sees the biggest believers technically underwater on their latest bets, they get terrified. They think, if he's losing, I don't stand a chance.
That is a grim picture. But I have to ask, play devil's advocate for me. Is the bull run actually dead, or is this just a massive pothole?
There is a strong counter perspective. Bernstein, a major research firm, believes the market has likely bottomed out.
Okay.
They are predicting a tokenization supercycle for the rest of 2026.
Tokenization supercycle. That's a buzzword. What does it actually mean for price?
It means the integration of crypto tech into real-world banking. And even JP Morgan, despite all their caution, they still have a forecast that Bitcoin could reach $170,000 in the next 6 to 12 months.
Wait, 170,000. We are at 75,000 today. That's more than a 2x from here. How do we even bridge that gap?
It's contingent on very specific things happening. One is the inclusion of digital assets in major indices like the MSCI.
Right, if pension funds can buy it.
If crypto gets added to the standard baskets that pension funds buy, it unlocks a fire hose of institutional money. But, and this is a massive but, it all depends on regulation. Which brings us to the drama in Washington.
Right, the White House summit. I read about this. It sounded like the principal calling the bullies into the office.
It was intervention.
Summoning the banking execs and crypto execs, including Coinbase, to sit in a room and hash it out.
They had to, because right now, there is a legislative deadlock that is paralyzing the industry. And to understand why your Bitcoin is down, you actually have to understand two specific bills.
Okay, hit me with the alphabet soup.
First, we have the Genius Act.
Modest name?
Very. This was signed into law back in July 2025. It's already in effect. It established rules for stablecoin reserves.
Okay.
Basically, it said if you issue a digital dollar, you have to actually have the real dollars or treasuries to back it up.
Which is good. We don't want another FTX where the money isn't there.
Correct. That part is solved. The problem is the bill that hasn't passed, the Clarity Act or the Market Structure Bill.
And this is where the war is.
This is the war. And the core of the conflict comes down to two words: yield versus rewards.
That sounds like semantics. Why are they fighting over words?
It's not just words. It's about who gets to keep the profit. Think about it. Coinbase and Circle hold billions of dollars in U.S. treasuries to back their stablecoins.
Right.
Those treasuries pay, what, 4 or 5% interest? Coinbase wants to pass that interest on to you, the user, as a reward.
Which I want. If I'm holding the money, give me the 5%.
But the banks look at that and they scream, shadow banking.
Shadow banking. That sounds nefarious.
It sounds scary, but it just means performing banking functions, like taking deposits without being a regulated bank. Their fear is deposit flight. If you can keep your money in a stablecoin wallet that pays 5% interest and it's instantly accessible, why would you ever keep your money in a Wells Fargo checking account paying 0.01%?
I wouldn't. I'd move it all in a heartbeat.
And that is the bank's nightmare. Standard Chartered estimates that if this isn't regulated, $500 billion could leave U.S. banks by 2028.
$500 billion.
Yes. That destroys the bank's ability to lend. It threatens their entire business model. So the banks are lobbying hard to ban non-banks from offering yield. They want to kill the killer app of crypto.
And Coinbase presumably says that a ban kills their business model.
Exactly. Coinbase gets about a fifth of its revenue from this, but here is the plot twist that nobody saw coming. It's like a scene from a movie. Tether.
Tether, the stablecoin issuer, they are usually the outlaws of the industry.
Usually. But reports coming out of Washington suggest that Tether is actually siding with the banks on these yield restrictions.
Wait, what? Why? That seems like voting against their own industry.
It's 4B chess. Tether has never shared yield with its users. They keep all the profit from the reserves for themselves. That's how they make billions.
I see.
By siding with the banks to ban yield sharing, they are trying to kneecap their competitors like Circle and Coinbase, whose whole marketing strategy is we pay you yield.
That is ruthless. I don't pay yield anyway, so let's make it illegal for you to do it.
It leaves Coinbase and Circle completely isolated. And this regulatory uncertainty is the other massive reason why crypto prices are so volatile. The market hates not knowing the rules of the game.
Okay, so let's take stock. Crypto is crashing because of a liquidity vacuum and a regulatory war. Tech stocks are expensive. Banks are fighting for survival. If I'm an investor looking for safety in 2026, where do I go? Please don't say under the mattress.
Well, historically, when people lose faith in digital money and paper money, they go back to the original money.
Hard assets.
Hard assets. We are seeing a historic run in gold.
It's so ironic. Digital gold, Bitcoin is tanking, but actual heavy, shiny gold is skyrocketing.
The divergence is incredible. Gold is targeting between $4,700 and $5,000 an ounce.
$5,000. That's uncharted territory. Who is buying it all? Is this just panic buying by regular people?
No, the scale's too big for that. It's the biggest whales of all. Central banks. For the first time in 60 years since 1968, central banks are holding more gold than U.S. treasuries.
Pause on that. That feels like a massive shift in the global order. Central banks prefer gold bars to U.S. debt.
It's a defensive move. They're diversifying away from the dollar. They are preparing for a world that is more fragmented.
Right, think about the sanctions we've seen.
Exactly. If the U.S. freezes your dollar reserves, you're in trouble.
Yeah.
If you have gold bars in your own vault, nobody can turn that off. It's the ultimate insurance policy.
So the smart money, the sovereign money, is betting on hard assets because they don't trust the geopolitical landscape. Does that apply to other commodities? Is oil riding this wave?
Completely the opposite. This is part of that multidimensional confusion. While gold soars, oil is in a slump.
Really?
Brent crude is expected to average just $58 a barrel in 2026.
That seems incredibly cheap. Usually when there's global tension, oil shoots up. Why is it down?
We are drowning in oil. It's a supply glut.
Yeah.
The global offshore sector and global shale, which now includes massive production from Argentina, not just the U.S., are pumping like crazy.
So there's just too much of it.
Supply is expanding 3 times faster than demand.
So we have too much energy, too much gold demand, but not enough liquidity for crypto.
That's the summary of 2026 so far.
Okay, let's bring this all together. We've covered a lot of ground. We've got the AI boom versus the labor gloom. We've got the crypto crash versus the gold rush, and the regulatory brawl in D.C. If you had to summarize the landscape for someone listening right now, how do you frame it?
I'd say 2026 is defined by extremes. It's a year where the middle ground has just disappeared. You have high-tech growth, but a weak labor market. You have physical assets hitting all-time highs, while digital assets face a crisis of confidence.
And the U.S. is strong, but the rest of the world feels shaky.
Right. U.S. economy showing resilience, while the global geopolitical situation feels very, very unstable.
It feels like you can't just buy the market anymore. You're either in the right spot or you're getting crushed.
Exactly. And that brings us to the strategy. J.P. Morgan runs a recession probability model. Right now, it is sitting at 35%.
So not zero, but not a sure thing either.
Not at all. The advice right now is agility. The easy money of 2025, where you could just buy an index fund and forget it, that's gone. Now, you have to watch policy. You have to watch the Clarity Act. You have to watch those liquidity flows.
So active management is back. You actually have to pay attention.
You do. And I want to leave you with one final thought, something the analyst mentioned that I think is the most important takeaway of this entire deep dive. We all know FOMO, fear of missing out.
Of course.
But the driver of 2026 isn't FOMO, it's FOBO.
FOBO.
The fear of being obsolete.
That sounds personal.
It is. Think about those companies spending billions on AI while freezing hiring. They aren't doing it just to grow their stock price. They are doing it because they are terrified that if they don't, they will cease to exist.
They're racing to survive.
They are. And that applies to investors and workers, too.
That's a heavy question to end on. It's not just about, will my stock go up? It's, will my portfolio or my career even matter in 5 years?
Exactly. Is your position resilient in a world where AI CapEx is the only thing keeping the economy afloat? That's the question for 2026.
If this helped you look past the headline and actually understand what's going on under the surface, make sure to like the video, subscribe to AI Uncut, and we'll see you in the next one.